I love companies with lower debt levels, and when you throw in high dividends, these American companies are worth checking out. Hold on to your passports. This is going to be a good one. Canada has some great investment opportunities, and we have seen many of them here on this channel. However, we live just above the biggest economy in the world, and that American market has even more opportunities for us to invest in a very thriving market. Join the conversation. Let us know in the comments if you have some American stocks, and if so, which is your favorite? Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a big thank you for that click. In this video, we will be looking at 5 American stocks available on the New York Stock Exchange that offer some pretty good dividends and a certain level of safety. The stocks I chose all have a return on equity above 30. In addition to that, they all have debt to equity ratios below 70, which means we are not looking at companies overburdened in debt. As far as dividends go, these 5 companies are all over 10%, so that is not too shabby. Before we jump into the list, I do want to address the current banking crisis and the effects on the market. All of these companies have experienced a skew to the downside in this crisis, and that is something we need to keep in mind when we look at some of the returns. Once this crisis has passed and the market recovers from it, these companies will shine much brighter. With that being said, let's do this. Kicking off this list, we have Sociedad, Quimica, Minera, SA with a ticker of SQM. They are a Chilean commodities producer with significant operations in lithium, potassium fertilizers, iodine, and solar salts. Between the EV market and the need for fertilizer, this is a company meeting the need of both of those industries. They have a market cap of $21.38 billion and a relatively average beta of 0.97. Their earnings per share, that comes in at 14.09, and their price to earnings ratio is on the low side at 5.31, which is great. Their return on equity, that comes in at 96.08%, and they have a debt to equity ratio of 60.4%. That is absolutely perfect. Their dividend yield, that comes in at 10.62%. It is paid out quarterly in the amount of $3.81 USD per share. This dividend, as well as all of these dividends today, are floating, so it does move a lot depending on the market conditions, more or less the price of the commodities in this situation specifically. Their payout ratio, it comes in at 56.39%, so this dividend is sustainable, which is great. When we switch over to their growth, when we look at their 3-year return on investment, that comes in at 255.87%. That's not too bad. We add in their dividends, and that total return comes up to 307.31%. Holy banana bread, that is really good. When we look at their return on investment for 1 year, that comes in at negative 7.72%. Adding in their dividends, we get a total return of 1.92%. Remember that financial crisis I was talking about? This is one of those skewed results thanks to that. Now their 2023 ROI, that comes in at negative 7.84%. Adding in the dividends, well, they don't have any dividends yet. Their first dividend doesn't actually come until next month, so that's still a negative 7.84%. Coming in at number 4, we have EGLE Bulk Shipping Incorporated with a ticker of EGLE. They are a dry bulk ocean transport cargo company. They transport a whole broad range of major and minor bulk cargoes, including coal, grain, ore, pet coke, cement, and even fertilizer. As part of the supply chain, this is a company that has a recession-proof feel to it. Their market cap, it comes in at $588.81 million, and they've got a slightly volatile beta of 1.33. Their earnings per share comes in at 14.68, and their price to earnings ratio comes in at a very low 3.08, so they definitely could be undervalued. Their return on equity comes in at 33.28%, and their debt to equity ratio, a nice little 43.91%. I am definitely liking these debt to equity ratios. When we look at their dividend yield, that comes in at 13.16%. It is paid out quarterly in the amount of 60 cents USD per share. And once again, we do have another floating dividend, and it does move quite a bit. In fact, it has ranged from $2.20 down to its low, which we're currently at 60 cents. Their payout ratio comes in at 51.70%, so this dividend is sustainable. Now, if we switch over to their return on investments with their 3-year ROI, we get 226.70%. Factoring in the dividends, it knocks it up to an impressive 303.54%. Now, if we switch to the 1 1-year ROI, we get negative 27.99%. Factoring in the dividends, once again, we get negative 17.49%. Now with their 2023 return on investment, it comes in at negative 7.02%. And they did have a dividend, so that brings our total to negative 5.79%. Once again, we are seeing that economic crisis pulling our numbers down, but this will all look a lot better on the other side. Taking our third spot, we have Mesa Royalty Trust with a ticker of MTR. They are a royalty company holding various oil and gas property royalties in Kansas, New Mexico, and Colorado. I love royalty companies, and despite the downturn in oil, this is a company that is poised to do very well once oil rebounds. They have a market cap of $26.78 million. Their beta comes in at 0.79, so they're a little bit less volatile than the market average. Their earnings per share, that comes in at 1.54, and their price to earnings ratio comes in at 9.33. Their return on equity comes in at a nice 110.83, and when we get to that debt to equity ratio, that comes in at 0, and that is not that unusual for a royalty company because, well, they own royalties. That's where their money comes. They don't really need a lot of overhead. Let's switch over to their yield. So their dividend yield, that comes in at 13.66%. It is paid out monthly in the amount of 10 cents USD per share. This is, of course, not a fixed dividend, and it does move a lot as they simply pass on their profits, and the dividend rises and falls with that. Their payout ratio comes in at 96.39%. It is definitely a little high, but they are passing on pretty much every bit of profit. When we look at their return on investment for 3 years, they had a return on investment of 122.96%. Adding in the dividends, we get a total return of 165.65%. If we switch back to the 1 year, for the 1 year, they still did well. They had a return on investment of 69.06% for a total return of 91.93%. In 2023, they got hit really hard. We have slumping oil, plus we got this economic crisis. Holy banana bread. It knocked down their ROI to negative 34.38%. Total return so far of negative 33.21%. I will admit that that is a pretty bleak number, and I am hopeful to see that number improve dramatically once we see oil start to rebound, and once that financial crisis is behind us. Those two factors will definitely help the outcome on this one. In our almost top spot at number 2, we have Cross Timbers Royalty Trust with a ticker of CRT. They are another oil and gas royalty company with royalties in properties in Texas, Oklahoma, and New Mexico. I do hold this stock in my RRSP. Their market cap comes in at $90.42 million. They've got a beta of 0.77, so they are a little less volatile than the market average. Their earnings per share comes in at 1.60, and their price to earnings ratio comes in at 8.44. I love this number. Their return on equity comes in at 338.4. Factor in as well, their debt to equity ratio comes in at 0. I love those two numbers. Their yield comes in at 14.37%, so those dividends are paid out monthly in the amount of 11.5 cents USD per share. This as well is not a fixed dividend, and it does move a bit as they simply pass on their profits, and the dividend reflects how well they are doing. Their payout ratio comes in at 100%, and that is them passing everything on to you guys. I would still like to see that a little bit smaller, because even though these royalty companies don't have a lot of overhead, they do have some. Let's take a look at their returns. Their 3-year return on investment, that comes in at 171.29%. Factoring in the dividends, we get 249.08%. Their 1-year return on investment, that comes in at negative 2.95%. Adding in the dividends, we get 12.10%, so that's not too shabby. And for 2023, we've got a major drop. Their return on investment comes in at negative 46.60%. When we add in the dividends they've received thus far, that brings it up to negative 44.91%. This is even more dismal than the last stock, but once again, once oil rebounds, and once we get through this economic crisis that we're in right now, between the two of them, I am expecting to see this rebound quite a bit. In our top spot at number 1, we have Pioneer Natural Resources Company with a ticker of PXD. They are based out of Irving, Texas, and they are an independent oil and gas exploration and production company that primarily focuses on the Permian Basin in Texas. This is a company that will do very well when oil rebounds. They have a market cap of $43.83 billion, and they have a beta of 1.44. There's a little bit of volatility there, but it's not too bad. Their earnings per share comes in at a whopping 31.17, and their price to earnings ratio is a very nice low 5.84. Their return on equity comes in at 34.58, and their debt to equity ratio comes in at 25.67. That's not too shabby. When we look at their dividend yield, it comes in at 14.98%. That is paid out quarterly in the amount of $5.58 USD per share. And yep, you guessed it, we have another floater. Their dividend used to be much smaller, down around 60 cents, but this has risen big time in the last year. Their payout ratio is coming in at 81.72%. Let's take a look at some of these returns. Their 3-year return on investment comes in at 176.71%, giving us a total return of 235.08% after those dividends are factored in. Their 1-year return comes in at negative 25.54%. Adding in the dividends, it brings it up to negative 14.40%. When we look at this year, 2023, their return on investment is sitting at negative 19.22%, and they've got a total return of negative 16.75%. Once again, this is a company that once the economic crisis passes and we get some boosts in the price of oil, they're going to be absolutely fine. These are great stocks for those looking to add a few American dividends to their portfolio. Just remember though, if you hold American dividend stocks in your TFSA, you will lose 15% as a withholding tax without any way to get that money back. The best place for American dividends is in your RRSP or, your personal accounts. In a non-registered personal account, you will still get charged that 15%, but you can get it back as a tax credit when you file your taxes. As always, before you jump into any stock you see on YouTube, be sure to do your due diligence so you can feel confident in the decisions you are making before you put your hard-earned money on the line. Keep the learning going. Watch my video on Canoe EIT that is linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.